Hello everyone. Now we proceed to a third part of IAS 8, accounting policies, changes in accounting estimates, as well as prior period errors. We are just going to take a look at two worked examples and then it will be over. So just tune yourself. Now let's take a look at this example. It's come from ACCA December 2010. Actually, it's a question that was asked a long time ago, but it is still relevant. Now just start with explanations here. Part A, we are told, IAS accounting policies, changes in accounting estimates and errors, contains guidance on the use of accounting policies as well as accounting estimates. Yeah, that's right. It speaks of accounting policies, accounting estimates, but also prior period errors. But the question is specific on policies and estimates. What are we required to do now? We are told, explain the basis on which the management of an entity must select its accounting policies. The basis to select accounting policies. On what basis should management use so as to know the accounting policies? And we are told to distinguish it with an example between changes in accounting policies and changes in accounting estimates. Now about this, I think that in question number 1, we explained everything. Let's just go fast in this. As my main goal is on part B that involves calculations, it involves computations. So let's just take it a look just a bit. So simply speaking, we say it this way. When management needs to establish accounting policies, first of all, they have to refer to a specific standard that we call IAS, International Accounting Standard, or currently they are called International Financial Reporting Standard, or an interpretation on the IFRS. It may happen that an IFRS has been established, but to make it more clear, an interpretation can be established too. So first of all, management should take a look on whether a specific standard explains the treatment of a certain transaction or event. But also we are saying that in the absence of a standard, if there is no such standard that I just spoke about, if there is no this specific standard I spoke about, management should use judgment. So management should use judgment in determining the actual accounting policies, so as to deal with these transactions or events. But after dealing with judgments, lastly, we said that management could also refer or consider other pronouncements of other standard setting bodies. You could check for other standard setting bodies in the world and take a look on how they deal with such an event or transaction, and they could reach at a solution. So it's just like this. Now going further, we are told that a change in accounting policy usually relates to a change of principle. We spoke about this. We said that a change in accounting policies could be due to change in measurement basis. Let's say its inventory was being measured using FIFO basis and now we're using AVICO. But also we said it's due to presentation, change in presentation. That's what they're just saying here, change in the principle. Means change in measurement, could be change in presentation, it could be change in disclosure, but also it could be change in recognition. You are recognizing something as an expense in the income statement, but now you are recognizing it as an asset in the statement of financial position. Actually, you said that accounting policies are applied for retrospectively. So you go back as much as you can if you see that there has been a change in the accounting policy. But what of accounting estimates? We said that accounting estimates are just used to measure the carrying amount of assets and the liabilities. Actually, if you have an asset at cost in the statement of financial position and you charge depreciation, that depreciation is an accounting estimate. So you learn how much to reduce your asset in the statement of financial position so as to reach at the carrying amount. So we say that a change in accounting estimate is a reassessment. This point is very, very important. A change in accounting estimate is the reassessment of the expected future benefits. Reassessment. That's why I gave you an example and said that if an asset had a useful life of 10 years, you judged it to have a useful life of 10 years, let's say it was 2 years ago, but now you see that it has a useful life of 12 years. There has been a change. We believe that 2 years ago, 10 years was the true useful life according to the information that was available at that time. But after reassessment, we have observed the difference. That's why accounting estimates are applied for prospectively. Now, in this case, I'll not just be talking, we'll go directly and really see how to deal with such a question. So don't worry, just finishing up here and we'll go there directly. So here we are told, for example, a change from non-depreciation of a property to depreciating it over its useful life. This is the change in accounting, what? In accounting policy. Now, as I said changes in accounting, changes in useful life of the asset, depreciation methods, all of those refer to actually change in accounting policies, but this is different. Please listen, you are not depreciating the asset, but now you're depreciating it. So this is the change in accounting policy. But changing the estimate of its useful life is a change in accounting estimate. And we said changes in accounting estimates are applied for prospectively. Now I think we are ready and we can go to the question. Let's go to another question that involves calculations. Let's go to part B now. This is part B. This is also this part A, and this one is part B. Now let's take a look at this part B. Part B, Roman 1. What of it? What are we required to do? We are told here that the directors of Tanshil are disappointed by the draft profit for the year ended 30 September 2010. The company's assistant accountant has suggested 2 areas where she believed the reported profit may be improved. So actually the directors see that the profit is actually disappointing. Maybe it's too low, maybe it's too low compared to the expectations, and they're disappointed. And the assistant accountant has just made a review, and she's just giving a report on how the reported profit may be improved. Now, this is a suggestion. Roman 1. This is what the assistant accountant is saying. Now listen very carefully. When reading of these matters, you have to understand, is this a change in accounting estimate? Is this a change in accounting policy, or is it a prior period error? That's what we're going to do here. All right, read. We are told here, a major item of plant that cost $20 million to purchase and install on 1st October 2007 is being depreciated on a straight line basis over a 5-year period, assuming no residual value. Now, if you just reach up to here, you have to ask yourself, up to here, in case there was nothing else, what would you have done? Now, if you take a look at this, we are told that the asset had a cost of 20 million. This asset had a useful life of 5-year period, 0 residual value. If it were you, how would you have computed depreciation here? We would have taken cost, that is 20 million, minus residual value, that is 0, will remain with 20 million, divided by 5, ending up with 4 million. So our expectation would have been that each year, a depreciation of $4 million would have to be charged. Now let's proceed with the explanations. Remember, this was on 1st October 2007. The plant is wearing well, and at the beginning of the current year, all right, you know, this current year ends at what? The current year ends at 30 September 2010. If you have just taken a look at the question, here, we are told that the year ends 30 September 2010. That means the year started on 1st October 2009. 20 October 2009, that means 2 years have passed from this date. And so we should have charged depreciation twice. So $4 million depreciation for the first year and $4 million depreciation for the second year. What amount would you have remained with? We expected to remain with 20 million minus $8 million. That would have been $12 million. That is just our expectation, but we are still reading the question. But you have to develop something. So we are told here, I think we read this already. We are told that the plant is running well, and at the beginning of the current year, the production manager believed that the plant was likely to last 8 years in total. Now, do you see this? The plant is wearing well, and at the beginning of the current year, on 1st October 2009, 2 years on from actually the date of purchase of the plant, we believe now that we believe now that the plant was like it last 8 years in total. You have to listen. You have been told 8 years in total. By being told 8 years in total, it's like even if the asset had not been used even once, we would have said it had a useful life of 8 years instead of 5 years. So you have to be very careful here. You have to distinguish these two terms. Let me write it here for you. You have to be very careful about this. You will be told useful life, but also you could be told remaining useful life. These are two different things. If you are told useful life, if you're told remaining useful life, actually, that means that the life that the asset has remained with, let's say 6 years. But if you are told the useful life, that means it's a revision. If you are told useful life is 10 years and the asset has already been used for 3 years, then you have to subtract the 3 years to have the remaining useful life. So be very, very careful when dealing with these matters. You should really pay attention, be attentive. So we are told that the asset is believed that the plant was likely to last 8 years in total. The question was very clear from the date of its purchase. Not everyone will give these explanations in an exam. You should know. If you are not told the remaining life, that means it's the total life from the beginning. So it's you who will have to deduct the years that have passed already, right? So what would we have to do? We are told here that the assistant accountant has calculated that based on an 8-year life and no residual value, the accumulated depreciation of the plant at 30 September 2010 would be 7.5 million. You know, this was very, very wrong. How you just try to look how they computed depreciation. It took $20 million and divided by 8 and then multiplied by 3 years. 3 years has passed and he has now revised the depreciation, the previous depreciation. This is wrong. You know, the changes occurred on 1st October 2009. So since the change of depreciation is a change in accounting estimate, it should be applied prospectively from the current period going further. You should not revise it in the past periods. But what they did here is they revised it in past periods. They took 20 million over 8. This was very, very wrong. You do not have to revise depreciation of past periods. As I said, we said that depreciation for past periods would just be 20 million over 5 years. That was the original useful life. That was 4. So up to this October 2009, 2 years have passed. The true accumulated depreciation is 8 million. But depreciation for this year would have to be charged considering this new remaining useful life. Right. Yeah, so this is what should have been done. So the accountant actually was wrong. That's why you are being told the assistant accountant. So we're just going to correct this. So just be patient. So here in the financial statements for the year ended 30 September 2009, the accumulated depreciation was 8 million. This is what we are speaking about. It should have been 8 million. That is 20 million divided by 5 times 2 to get the accumulated depreciation of 8 million. This is right. And therefore, by adapting 8-year life, TANSHEL can avoid a depreciation charge in the current year and instead credit 0.5 million to the income statement in the current year to improve the reported profit. You see how this assistant accountant was going wrong. The assistant accountant is saying that, oh, up to the beginning of 2009, we had accumulated depreciation of 8 million. But because you have revised the change in useful life, the total depreciation for 3 years should be 7.5. So actually, I do not have to charge depreciation for this current year because I had already charged 8, but I should have charged 7.5. So I have to reduce the depreciation, thus increasing profit, which is very, very wrong. I'm repeating again. A change in accounting statement is applied prospectively from the current period going further forward. That's why we are told that explain if there was an error. Actually, the assistant accountant has had these ideas, but we are just going to explain. This is not true about accounting policies, but we will not read it now. Let's just go take a look at what we are required to do and go to the solution of that first question. So required here, required. Comment on the acceptability of the assistant accountant suggestions and quantify how they would affect the financial statements if they were implemented under IFRS, and we are told to ignore taxation. Ignore taxation. Now let's take a look at what should have happened in our scenario. I think we have gone through it a lot, so I'll just be direct. So this is case 1 that we are speaking about. Now listen, I have to do some calculations here. Let me show you. Before going further to read, I think we should write something. We are told that the asset had a cost of $20 million, useful life of 5 years, and residual value of 0. So what should have been done? Actually, this asset, we were told the asset was bought on it was 1st October 2007. So this year, this was the beginning of the year, and this year will end. When will the year end? The year will end at actually on 30 September 2008, right? This is how it would end. What would have been the depreciation? Compute the depreciation for this first year. The depreciation should have been this way. Cost, that is 20 million, minus residual value, that is 0, actually divided by the useful life, that is 5, and this would have been 4 million. So for the first year, it would have been 10 million. What about for the second year? Depreciation for the second year, which is 1st October 2008 up to 30 September 2009, depreciation would have been the same. At what value would it have been? Depreciation would also be 4 million, right? Depreciation will be 4 million, giving you a total of 8 million, giving you the accumulated depreciation here, accumulated depreciation of 8 million, just like this. So we would have a depreciation accumulation of 8 million, sorry. So we are told at this date that on 1st October 2009, listen now, on 1st October 2009, you know, this year ends actually at 30th September 2010. It ends here. But at this point, at the beginning, just at the beginning of the year, we are told that the useful life was revised and it was found to be 8 years now. So since this has changed, you have to recompute the depreciation for this period. So how would have been the depreciation? The new depreciation actually would have needed, you know, the normal formula for depreciation is cost. This is the normal formula. Let me write the normal formula here. It's usually cost minus scrap value divided by the remaining, divided by the useful life. But in case there is a change in useful life or residual value or anything, even when the cost changes, let's say under evaluation model, something has changed, you have to change these two. So here, instead of using cost, you would have to use the carrying amount. Carrying amount is at this date. So you take the carrying amount of the asset, and then you less scrap value as usual. You divide by the remaining useful life, not just useful life. It's the remaining useful life of the asset that has to be used. Now, what would you have done here? Remember, you had the asset at a total cost of $20 million, but now it has actually depreciated by $8 million. So you would have to know the carrying amount. So let me call it CA. The carrying amount, which is 20 million minus 8 million, and you remain with 12 million. So this would have been the carrying amount. So the depreciation for this period would have been this way. We would have taken 12 million less scrap value, which is now 0, divided by how much? Remaining useful life. What is the remaining useful life? Remember, the useful life now is 8 years, but 2 years had passed. The first year here to 30 30th September 2008 and 30th September 2009. So we have only remained with 6 years. That means 8 minus 2, we subtract these 2 years. And what would be the result here? 8 minus 2 is 6. 12 million divided by 6 will remain with 2 million. So this is what should have been charged as the depreciation for this period. Now you see this. This is what should have happened. So the accountant, as the assistant accountant, was really wrong. This concept here needs you to explain the changes in accounting estimate that, just not here before we go to the solutions, we mean here that changes in accounting, I'm repeating, changes in accounting estimates are accounted for prospectively. Accounted for prospectively. You have to understand this very clearly. You account for such changes prospectively. Prospectively, that means they are applied for current and possibly future periods. If no changes occur, you can just apply them for current and future periods. So when reading the question, you have to ascertain on whether this is a change in accounting estimates or the change in accounting policy. As for changes in prior period errors, that's very easy to locate because it's clear, you know, obviously that there was an error. So this is what I just wanted to talk about. Now let's just go to explanations and finish up this question. This is case 1. Let's just go directly. I think we have gone through a lot. Now listen, there is a change in the estimate of the useful life of the non-current asset. This is obvious. It has changed from 5 years to 8 years, right? But also, it appears from the information that the increase in the estimated remaining useful life of the plant is based on a genuine reassessment by the production manager. You know, as I told you, something that leads to changes in accounting estimates, it occurs not because we made an error in the past, but because in the past we are right, but maybe due to new developments or new factors arising, we have come to a conclusion that it has to be changed. All right, again, the assistant accountant's computation of the financial effect of the revised life is not correct. I think we have corrected it already, that you cannot apply it retrospectively. If you computed depreciation in the past year and you have changed the useful life, you cannot go back and recompute that depreciation because this is a change in accounting estimates. All right, so let's just finish up. So here we are told, where there is a change in the estimated remaining life of a non-current asset, the excess of its carrying amount over estimated residual value is allocated over the revised remaining life. There is nothing much actually. I have done this in explanations. It simply means that the new depreciation, instead of saying the difference between cost and the scrap value divided by the useful life, I said take the difference between carrying amount and residual value over the remaining useful life. That's what I spoke about, and this is what is being written here. So the carrying amount, that is 12 million after taking 20 minus 8, as I showed, should be written off over the estimated remaining life, that is 6 years, 8 minus 2. Be careful when reading the question. If that question stated like this, let me show you. You have to read the question. Don't just read the questions actually without a deep thought. Here, they say that, they say that by adapting by the 8-year life, the 8-year life was adapted. I just need to the place where it was really spoken. Here, listen, the plant is wearing well, and at the beginning of the current year, the production manager believed that the plant was likely to last 8 years in total. Even if they said the plant was revised and found to have a revised useful life of 8 years, you would have to subtract 2. But if they said the plant had a remaining useful life of 8 years, that 8 years was the remaining. That means 2 years were already deducted. That means actually the revision was actually 10 years, but 2 years were already deducted. So be very careful with the word remaining. If you find the word remaining and you don't use it, or if you find the word remaining, you do not have to subtract these other years. So as I showed you, a depreciation of 2 million, that is 12/6, would be charged to profit or loss. This is depreciation, right? And if you have the depreciation, actually charge it to the statement of profit or loss, just as usual. So this is what should have happened. So this would have been charged to the statement of to the statement of profit or loss, with a carrying amount of 10 million being in the statement of financial position. Because if you charge an asset with the asset, remember the asset was having a carrying amount of 12 million and you have charged 2 million depreciation. That means we debit depreciation in the profit or loss by 2 million. We credit that asset by 2 million. So we would have deducted 2 million from 12 million, remaining with 10 million here in the statement of financial position. It should be noted that the revision to the estimated life of the plant would improve the reported profit by 2 million, being the difference between old depreciation and the new depreciation. That's why I'm just speaking right. All right, I hope everything was fine, but my main point here, you just have to be, all right, the time was almost over. Let's just wind up. We are told here that it should be noted that the revision to the estimated life of the plant would improve the reported profit by 2 million, being the difference. As you have seen now, without revising the useful life, the depreciation was 4 million each year. How was it obtained? It was cost 20 million minus residual value 0/5. That was 4 million. The original depreciation was 4 million. But now the revised depreciation is 2 million. So depreciation would have fallen by 2 million. From 4 to 2 million. Depreciation falling by 2 million indicate that profit would also have increased by 2 what? By 2 million. So this is how we deal with such questions. I think we have just remained with 2 examples on changes in accounting policies, as well as changes in prior period errors, I mean. And this Roman 2 here is an example of such a case. So we'll also see this. I urge you, if you haven't subscribed, you can just go to the YouTube channel, you just subscribe so that when everything is uploaded, you'll be aware of it and actually can grab it. But also in case you have maybe a situation, you need a certain video, you could just tell me and we could establish a session when I have my free time. All right.